Welcome back to the Quarterly Call. All content is for informational purposes and is not investment advice. Please consult with an investment professional. Today, we're dissecting the recently released Netflix Q2 2025 earnings call. Our mission, to really cut through the corporate jargon, pull out the truly impactful insights for you, give you a shortcut to what really matters in the world of streaming. Okay, let's unpack this.
Yeah, absolutely. And what's fascinating here is that understanding Netflix's latest moves isn't just about, well, one company. It's actually crucial for grasping the broader trends in how we all consume content and, what the future of our entertainment looks like and how a major player like Netflix is adapting in what is, let's face it, an incredibly dynamic industry.
You got it. So let's start with the financial pulse, because honestly, there was some genuinely good news in these numbers. Netflix increased its full-year revenue guidance. That's their updated forecast for how much money they expect to bring in. They bumped it from a prior range of about 43.5 to 44.5 billion, all the way up to 44.8 to 45.2 billion dollars. Now, while a chunk of that uplift is due to currency impacts, a weakening dollar, there's also clear positive underlying business strength driving it too.
That's right. And the good news, it sort of extends beyond just the top line. We saw healthy member growth. It actually picked up nicely right at the end of Q2 and beat expectations. Plus, we're seeing really strong momentum in ad sales. Okay, it's still from a smaller base, I grant you that, but it's on pace to roughly double revenue for the year. That's ahead of what they initially thought. And critically, operating expenses are essentially unchanged. So what that means is those higher revenues, they're flowing directly to profit margins, which leads to that updated full-year operating margin target increase from 29% up to 30%. It really shows Netflix's, demonstrating surprising resilience, even in a tough macro environment, and they're leveraging those different revenue streams effectively.
That paints a strong picture, definitely.
Yeah.
So, if Q2 showed this upside, and Q3 is actually forecasted at an even higher 31.5% operating margin. That percentage of revenue left after covering core costs. Why is the full-year guidance still pegged at 30%? Is there a specific timing thing going on, or are new spending levels coming into play that maybe you picked up on?
Yeah, that's a sharp question. And it is primarily a timing issue. Look, content expenses are expected to ramp up pretty significantly in Q3 and Q4. A lot of their biggest new and returning titles, plus those live events, they're all scheduled for the back half of the year. And Q4 typically has a heavier film slate anyway. They're also planning increased marketing spend to support this massive slate. Makes sense. And they'll continue, aggressively building out their ad sales infrastructure. But importantly, even with that back half ramp in expenses, operating margins are still expected to be up year over year in each quarter. That includes Q4.
Okay, so it sounds like they've got the financial levers pretty well managed, but what about the broader economic climate? Consumer sentiment, inflation, all that stuff. Is that impacting their strategy at all? How are they viewing it?
Well, similar to the last quarter, they're carefully monitoring the situation naturally. But what's fascinating and maybe a little surprising is that they currently see, and I quote, nothing significant to note in their direct business metrics. So things like retention, still stable, still industry leading, no big shifts in the mix of plans people are choosing or the take rate for those plans. And recent price changes seem to be landing pretty much in line with their expectations. Engagement also remains healthy. They really highlight that entertainment, and Netflix specifically, has historically been pretty resilient in tougher economic times. They keep emphasizing their incredible entertainment value compared to traditional options and frankly other streamers, especially when you consider US prices starting at $7.99. It's very accessible.
Right, so financially robust, seemingly resilient in a tricky economy. But at the end of the day, those strong numbers are fueled by one thing, really, content. So from the fiscal pulse, let's talk about the beating heart of Netflix, its entertainment engine. There's been this ongoing question, hasn't there, about whether Netflix is a hit-boosted or truly hit-driven business, especially given that observation we heard before, that no single title usually drives more than 1% of total viewing.
Yeah, it's a good distinction to make. And look, while big hits can certainly accelerate growth, no doubt about it, the core strategy isn't really about relying on one single massive hit after another. Instead, it's more about maintaining what they call a steady drumbeat of shows, films, and, soon, games that members consistently love and frankly come to expect from the service. This focus on quality at scale, I think that's the key phrase. It's kind of exemplified by their, 44 individual Emmy nominations this year? Pretty impressive. The key insight here, I believe, is that they're not just aiming for simple subscription growth anymore. They're aggressively competing for total audience timeshare, positioning themselves more as an every occasion entertainment hub, if you will.
And it certainly looks like they're leaning into a massive content slate for the back half of 2025.
Yeah.
What are some of the standout titles or maybe overarching themes we should be paying attention to?
Oh, the back half of 2025 is absolutely stacked.
Yeah.
Huge returning juggernauts. Think about the return of Squid Game, already the third most popular non-English series ever. That's massive. Alongside new seasons of Wednesday and Stranger Things, which are obviously huge global phenomena. Plus, new stuff like Eric Bana's Untamed, Leanne Morgan's comedy special, and what they're calling their most anticipated slate of new movies ever. That kicks off with Happy Gilmore 2, believe it or not, a new Knives Out film, which everyone's excited about, and new projects from really renowned directors Noah Baumbach, Guillermo del Toro, Catherine Bigelow. This blend of, established global hits, strategic genre expansion, and diverse formats. It really reveals a clear push for dominance across the board.
Wow. Okay. And this momentum, is it expected to continue into 2026? Or is this just a big push for the end of 25?
No, absolutely. The outlook for 2026 looks equally strong, if not stronger in some ways. You can look forward to upcoming films like The Rip with Ben Affleck and Matt Damon. That sounds interesting. Apex, the F1 movie with Brad Pitt. Enola Holmes 3, and you remember, Enola Holmes 2 was actually their biggest movie in 2023, so high hopes there. And yes, Greta Gerwig's Narnia is on the docket. I'm personally fascinated to see how her distinctive storytelling translates to such a beloved classic. That could be huge. For returning series, we're talking Bridgerton, One Piece, which was a massive hit, Avatar, The Last Airbender, The Gentleman, Beef, which was an award winner in 2023, remember? 3, Body Problem, Love is Blind, Outer Banks. I mean, the list goes on, and what's really striking is the sheer global breadth of their upcoming slate. Massive investments in series from France, like Lupin, Spain with Berlin, Colombia with 100 Years of Solitude. Plus, they're doubling down on live events, like you mentioned that NFL Christmas Day doubleheader, Dallas versus Washington, Detroit versus Minnesota, big matchups. They seem very confident this momentum will continue right into 2026. Really solidifying their position as a global entertainment powerhouse.
Okay, that's a lot of exciting content. But given all that, some people are still raising concerns about domestic viewing share. Nielsen Gauge data shows it's been a bit stagnant. Does this suggest they need to maybe rethink their content investments? Perhaps spend more or spend differently to really increase that share?
Right. Well, their long-term goal definitely remains to grow viewing share over time. And it's worth noting, they've actually maintained their share pretty steadily, even while a whole bunch of new streaming services, free and paid, have entered the market. And you also have the impact of their paid sharing initiatives rolling out. Now, their content amortization, that's basically how they account for the cost of their shows and movies over time, sort of like depreciating an asset. That has grown significantly. We're talking over 50% since 2020, from under $11 billion to over $16 billion expected this year. That's a huge increase in spending. And they directly connect that increased spending to increased engagement, revenue, and ultimately profit. Their model is really designed to sustain healthy revenue growth, reinvest that money to improve all aspects of the service, and drive this kind of positive, self-reinforcing cycle, a flywheel, if you will, of growth by adding value for members globally.
Okay, so it's about the long game there. Now, beyond the core content offering, Netflix is clearly exploring new avenues for growth and engagement. Let's dive into some of those strategic partnerships in new areas, maybe starting with that TF1 deal in France. What's the core rationale behind this new collaboration?
Yeah, the TF1 partnership is interesting. The fundamental purpose, they say, is that members consistently want more variety, more breadth of content. Pretty straightforward. So this partnership is essentially a mechanism to expand their entertainment offering, specifically for what they call highly relevant local for local content in France, which is a country with really strong demand for its own programming. Why now? Well, it's largely because of their recent investments in enabling capabilities, things like live programming, the ads tier, and that new user interface we'll probably talk about. Those pieces needed to be in place. And why TF1 specifically? Well, France is a big territory. TF1 is the leading local programmer there. They felt there was strong alignment in how the partnership would be shaped, mutual value generation. And importantly, it's an opportunity for Netflix to learn how to scale this kind of local content partnership to potentially more French customers and maybe replicate it elsewhere.
Makes sense. Sticking with new content types, let's talk live sports. We're seeing industry reports buzzing Apple securing F1 rights, other sports properties looking for deals. What's Netflix's updated approach to sports rights? I mean, where do they draw the line? Are they going all in?
Right, so they're very clear. Sports are a subcomponent of our live strategy, and that overall strategy, they say, remains unchanged. The focus is squarely on what they call ownable big breakthrough events, things that audiences love, get people talking, but also, and this is key, make economic sense for Netflix, they emphasize that Netflix brings a lot to the table in these deals. Reach, promotion, tech, and any deal has to reflect that value going both ways. Now, while live content overall is still a pretty small part of their total content spend and total viewing hours, they believe it has an outsized positive impact on conversation, buzz, member acquisition, and they suspect retention too. They're clearly very excited about upcoming things like the Canelo-Crawford fight in September. That's a huge boxing match. The SAG Awards returning, their weekly WWE Raw matches starting soon, and of course that NFL Christmas Day doubleheader we mentioned. The intent, they say, is absolutely to continue investing and growing their global live capabilities in the years ahead. But strategically, not just buying up any rights available.
That brings up a good point, the capabilities needed. What investments have they actually made to increase their live event production capabilities? I mean, what can they do in-house now that maybe they couldn't do last year? And what's the sort of timeline for being able to handle really large-scale event production themselves?
Yeah, they compare it, interestingly, to the early days of their original scripted programming, where they essentially started with zero production capability in-house. So the plan is they'll continue to use partners who already have existing production infrastructure like CBS for the NFL games. That's a great example. But they'll also selectively bring some capabilities in-house over time. This mix, using partners and building internally, acts as a powerful scaling tool for them. They point to significant progress already made in their live capabilities, citing the recent success of their first ever concurrent pair of live events, that was the Taylor versus Serrano boxing match globally, and WWE SmackDown outside the US. Apparently, both were delivered at scale, with high quality, simultaneously. That's a big technical hurdle cleared. And they say they have a robust roadmap of features ahead to enhance these live experiences for you, the viewer.
Okay, let's pivot slightly to another area of original success, animation. Specifically, K-pop Demon Hunters seems to have been a real hit. What are the key learnings from that? And I guess, should we expect more animated musicals featuring fictional bands? Is that a new niche for them?
Yeah, they seem immensely proud of the phenomenal success, as they put it, of K-pop Demon Hunters, especially as an original animated feature. That's a notoriously challenging area, though they've had other hits like Leo and Sea Beast recently. They highlight the importance of getting that mix right, the music, the pop culture elements, alongside just strong storytelling and animation innovation. Apparently the music, particularly songs like Golden and Soda Pop, is really driving fandom for the fictional K-pop band in the film. It's piercing the culture, getting radio play, all from a Netflix exclusive film. That's a fantastic example of building out intellectual property purely within their own ecosystem. So will there be more? They definitely hint at future original animated projects, mentioning one called In Your Dreams. So yeah, I think it's an area they'll continue to invest in.
Right. Let's move on to innovating the experience itself, the tech side, and the future of how we actually engage with Netflix. With this expansion into diverse content genres, live sports, partnerships, gaming, is there a possibility we might see additional service tiers based on content types? Or do they plan to keep all content available across both the ad-free and the ad-supported price points?
Well, they give the classic never say never response, which you'd expect. They remain open to evolving their consumer-facing model over time. However, they did outline some core principles that they say won't change significantly. Things like providing member choice, different plans, different price points, different features. That's key. Ensuring accessibility. So having entry-level price points for new members globally. And, of course, achieving reasonable returns for the business itself so they can keep reinvesting in content and features. They also mentioned, considering the complexity of the choice stack, you don't want to confuse people with too many options, but fundamentally they reiterate their belief that the bundle is a great value for members, offering that wide range of entertainment easily and affordably in one place. And they expect that bundled approach to remain an important feature for the foreseeable future. So no immediate plans for content-specific tiers, it seems.
That makes a lot of sense. Keeping it simple has always been part of their appeal. Okay, focusing on the new UI UX, that's the user interface and user experience, basically how you navigate and interact with the app. Why is this new design so important, especially as live content expands? And are there any metrics they shared about improvements since its launch?
Right, the UI UX refresh. They basically said the previous UI was designed for the Netflix of 10 years ago. Whereas the business today has significantly evolved and now includes a much wider breadth of entertainment options: TV, film, games, and now, importantly, live events. So the new UI is crucial for helping members understand that there's now a reason to, quote, tune in at 7:0 p.m. on a Friday night. It's a completely different discovery job than just helping you find something to watch whenever you happen to show up. It requires highlighting timeliness. They also mention leveraging newer technologies, like real-time recommendations, meaning the suggestions you see aren't static anymore. They dynamically adapt based on what's trending, what's new, maybe even your recent viewing or the time of day. So the Netflix you get on a Tuesday night when you're tired might suggest, I don't know, a comforting comedy, versus a Sunday afternoon when you might be looking for more intense drama or a big event. They seem confident this new experience will drive better performance across various metrics and, importantly, serve as a much better platform for future improvements and features.
Interesting.
Let's talk about another big tech topic, generative AI initiatives. Where do they see Gen AI being most impactful for them? Is it primarily going to boost revenue somehow, or is it more about improving expense efficiency in their operations?
They expressed real conviction here. They see AI as an incredible opportunity to help creators make films and series better, not just cheaper. That was a key distinction they made. They described it as AI-powered creator tools designed to help real people, not replace them. In production, they gave examples like pre-visualization, helping plan shots, or in visual effects, like de-aging technology, which used to be incredibly expensive, becoming more accessible beyond just the biggest budget projects. And they highlighted a specific example, El Eternauta, a production from Argentina. Apparently, AI-powered VFX enabled them to create a complex building collapse sequence 10 times faster than traditional methods and at a feasible cost for that production. And this is significant. They said it marked the very first Gen AI final footage to appear on screen in a Netflix original series or film. So AI didn't just assist behind the scenes, its direct output was part of the finished product you see. That really signals a new era of creative collaboration between humans and AI. The takeaway is that these tools genuinely help creators expand their storytelling possibilities, things they might not have been able to afford or achieve before. And that's just production. They also see tons of opportunity in the member experience itself, particularly in enhancing personalization and recommendations using these newer generative techniques. They mentioned they're piloting a conversational experience. Imagine being able to just ask Netflix using natural language, something like, hey, I want to watch a film from the 80s that's a dark psychological thriller, and it understands and finds relevant options. This kind of improved discovery, they argue, acts as a powerful force multiplier for their content investment. It helps connect you, the member, with titles you'll truly love but might have missed otherwise. They also touched on advertising how generative techniques could potentially lower the high hurdle for creating compelling, brand-forward ad spots that fit well within their content. And just for clarity, they mentioned Eyeline. That's apparently the name of their production innovation group within Scanline, where a lot of this VFX and AI work happens.
Very cool stuff on the horizon there. Finally, in this tech segment, let's touch on their gaming ambitions. With partnerships like Grand Theft Auto and even integrations with platforms like Roblox, what are the near-term monetization opportunities they see within gaming? Or is it still mostly about engagement?
Yeah, they frame near-term gaming monetization pretty similarly to how they approached other new content categories initially. Essentially, delivering more value to members through games should lead to increased user acquisition, better retention, and maybe over time, a greater willingness to pay for the overall Netflix service. They did confirm they're already seeing positive proof points of this, although still at a small scale relative to the overall business, of course. They plan to ramp up investment in gaming, but stressed they'll remain disciplined to ensure that investment actually translates into tangible member value. They noted good progress with both licensed games like the GTA trilogy, which was huge for them, and their own developed games like Squid Game, Unleashed. So you should expect more in both categories, licensed hits and original IP games, plus maybe new kinds of interactive experiences. They reiterated they remain open to evolving the monetization model specifically for games down the road, but significant scale is needed first. They keep emphasizing the sheer size of the gaming market, the very, very large total addressable market, or TAM, suggesting they see a huge long-term opportunity here.
Okay, let's pull back now and look at the big picture, especially thinking about the competitive landscape. We hear reports like YouTube now exceeding Netflix in U.S. TV timeshare, according to Nielsen. Does Netflix see an opportunity, perhaps, to bring some of those notable YouTube creators exclusively over to its platform?
They definitely confirmed their desire to collaborate with the best creatives on the planet, as they put it. And they were clear that it doesn't matter where those creatives come from, whether it's traditional Hollywood, Korea, India, or indeed social media platforms. They're looking for talent everywhere, including undiscovered talent. That page is that Netflix offers phenomenal distribution, desirable monetization options, brilliant discovery tools within the platform, and a huge, hungry global audience. Now, they did acknowledge that, quote, not everything on YouTube will fit on Netflix. The formats and styles can be very different, but they believe some creators are a great fit. They specifically mentioned Miss Rachel, the children's entertainer, who apparently had 53 million views in just the first half of 2025 on Netflix. That's significant reach. They also expressed interest in potentially working with other big digital native creators like Sidemen or Pop the Balloon. So yes, they are actively looking at that space. But they also broaden the competitive view way beyond just YouTube. They see competition coming from linear TV still, other streamers obviously, video games, social media. They described it as a very dynamic competitive market. And the steady, inevitable shift from linear to streaming is just creating increasing competitive pressure for everyone. They specifically recognized free services like YouTube or FAST channels as strong competition, but highlighted that Netflix has a different profit model. They're competing, they said, to win the most profitable moments of your attention. But crucially, they pointed out that something like 80% of total TV viewing share globally is currently not won by either Netflix or YouTube. That massive chunk represents a huge opportunity, and that's where most of their money and attention is focused, converting that time over to streaming, and specifically to Netflix.
That's a really interesting perspective on the market share battle. Okay, finally, let's talk M&A, mergers and acquisitions. Netflix has a healthy balance sheet, lots of cash. We're seeing predictions of likely global media consolidation happening. What's their current view on potentially owning successful IP libraries or even studio assets that might come onto the market as others struggle or consolidate?
Yeah, they acknowledge that consolidation of traditional studio and network assets is probably likely to continue. But interestingly, they stated they don't believe it materially changes the competitive landscape for them or for legacy media overall. They reiterated their historical stance, which has generally been that they are builders rather than buyers, meaning they've always preferred to grow organically, build their own capabilities and IP in-house, rather than acquiring other large companies. And they still see a big runway for growth organically without needing to fundamentally change that playbook. They laid out their framework for evaluating any potential M&A opportunities that might arise. They ask, is it a big opportunity? Does it genuinely strengthen their entertainment offering or their capabilities? Does it truly accelerate their existing strategy? And all of that has to be weighed against the opportunity cost of distraction. Big acquisitions can be very distracting. They explicitly reaffirm they have no interest in owning legacy media networks. So don't expect them to buy a traditional broadcaster or cable channel group. They stress that their strong position allows them to be choosy. So the focus remains predominantly on organic growth, aggressive but responsible investment back into the business, and returning excess cash to shareholders through their share repurchase program. They expect to continue on that path for the foreseeable future.
Right. So really, it's like the key themes are strong financial management, allowing for big strategic bets, an ever-expanding content universe, pushing into live and gaming, and really leveraging tech like AI and the new UI to connect you with all that content more effectively. They're constantly evolving. Which brings us to a final thought. Thinking about how Netflix is so rapidly expanding its content, embracing live events, integrating gaming, leveraging AI for both creation and discovery. What do you imagine the Netflix experience will look and feel like for you 5 years from now? How might all these innovations actually redefine what we even expect from entertainment itself? Something to ponder. Thank you so much for tuning into the Quarterly Call. For more episodes, please remember to rate and follow our show. Until next time, stay curious and stay informed.